The transaction begins with this deposit in a Spanish bank. When the transaction is initiated, the Spanish bank reduces its deposit liability to its customer and reduces at the same time its holding of reserves at the Spanish central bank. The Spanish central bank, in turn, reserves its reserve liability to its customer, the Spanish bank, and replaces it with a liability to the Eurozone payment system. The payment system accepts, as a matter of mechanics, accepts the claim on the Spanish central bank. And we're halfway there. The payment system then extends, so this is the transaction from the previous slide. The payment system the transaction is continued with this claim of the Bundesbank on the payment system, the Eurozone payment system. Accepting that as an asset, the Bundesbank increases its reserve liability to a German bank, which, accepting that reserve as an asset, creates a deposit on behalf of its customer here in Germany, and the payment is completed. It began here with a deposit in Spain and ended here with a deposit in Germany. €1 on deposit in Madrid became €1 on deposit in Berlin, just as we expected. In the course of this transaction, bank deposits, reserves at the central bank, and claims on the payment system each played a role in the settlement. Reserves at the central bank we know as part of M0, the measure of money supply, deposit liabilities as part of M1. Claims on the payment system, as a quick aside, which is important enough that I think I should mention it, claims on the payment system don't figure into any standard measure of money supply, but as you can see, they serve an entirely parallel purpose to the other entries. And so let us suppose for the moment that the problem is with the notion of money supply and set it aside, at least for now. Each of these, reserves at the central bank, claims on the payment system, and deposits, each of these is money in the sense that it serves as a means of clearing payments, but each of these monies is quite distinct. One can be obtained in exchange for the other, as in the example. To clear payments, money of several kinds is exchanged. At what price do these exchanges occur? €1 in Madrid is €1 in Berlin, and just so with the intermediate steps. The relative price among the three types of money is 1. The payment system's function is to silently and automatically hold that fixed price at unity. When it is successful, the relative price of 1 is called par. What is it about the mechanics of the system that holds par? Adjustment is made to happen in balance sheet quantities, never in prices. Where in a floating exchange rate regime, the exchange rate could rise or fall in the face of persistent current account surpluses, say. In a monetary union, instead, claims accumulate in the payment system, as in the example. It is the unified payment system that ensures that par is held. Without it, the foreign exchange market would stand between the Spanish deposit and the German deposit, and the exchange rate would float to equate supply and demand. Thus, it is not a stretch to claim that the unified payment system is the essence of monetary union. It is the feature of monetary union that ensures €1 in Madrid is equal to €1 in Berlin. If a country were to exit the euro, you would know it because your payments to that country would stop clearing at par and instead would clear at something else. So this theoretical perspective leads us immediately to an interpretation of the ongoing crisis. Lately, the euro has been shaken to its foundation. Why exactly? Persistent external surpluses, principally on the part of Germany, give rise to many transactions like the one above, all in one direction, money flowing into Germany. As in the above transaction, claims on and to the payment system have expanded on both sides as these net money flows have accumulated there. This is a necessary and inescapable consequence of the system's maintenance of the fixed exchange rate of 1. Attendant macro difficulties have recently strained the finances of sovereigns on the Eurozone's periphery, casting doubt on the system's ability to hold par indefinitely. The symptoms are differential yields throughout the Eurozone with convertibility risk, the possibility of euro exit, now priced in. Interbank markets are nearly frozen, meaning banks find it difficult to meet their liquidity needs in private markets, and cross-border interbank markets are non-existent. And the yields demanded of peripheral sovereigns have spiked in recognition of the intertwining of national treasuries and national financial systems. Now, the ECB prefers to reason in terms of price stability, by which it means control of inflation, a focus it inherited from the pre-Euro Bundesbank. Logically, of course, the ECB's first job is to maintain par, because without par, there is no monetary union, and without monetary union, there is no ECB. So that's the theoretical perspective. Now, a few specific and current issues. Last week, outright monetary transactions. Last week, the ECB announced ex-ante unlimited ECB purchases of Eurozone sovereign debt. Mario Draghi defended the move, as I mentioned earlier, defended the move as necessary to restore the monetary transmission mechanism so that the ECB could return to what he views as its proper mission, inflation fine-tuning. So how does this work? The Euro system, which is the consolidated balance sheets of all of the national central banks of the Eurozone, in which we often simply call the ECB in casual speech, purchases in this kind of intervention, purchases sovereign debt. So let's take Spanish debt as a very relevant particular example. Purchases sovereign debt, so Spanish debt in this case, and expands one way or another, expands the reserves that it holds for the European banking system. So how is this supposed to help? So Spain, the Spanish sovereign, can effectively issue debt and do what with it? Well, it can, one particular use for that, the funds raised by that mechanism is to lend money to its banking system, to, at least in theory, restore some of the credibility of those banks. So issue loans to banks as somehow an asset, somehow a loan, let's say an asset booked somewhere in the Spanish treasury. The Spanish banks, accepting those loans as a liability, can do something. Perhaps issue new loans to Spanish business, potentially leading to increased investment and increased GDP, or another alternative, perhaps simply buying more of this same Spanish debt. I admit that I think that the full logical picture here is not entirely clear, but at least there's some chance that something like this or something like this could improve the financial health of Spain. So to what problem is this a solution? The ECB detects a convertibility risk premium, the price of the possibility that Spain would exit the euro. In the cost, it detects that convertibility risk premium in the cost to Spanish banks of short-term finance, relative to what German banks have to pay. This redenomination risk spread means that ECB interest rate decisions are not having an effect on the peripheral bank's costs of funds. And so the ECB has made the argument that intervention is needed so that it can get back to inflation targeting. But of course, there is a more immediate task for the ECB than getting back to inflation targeting. What ought to strike fear more deeply into the hearts of European central bankers is not the possibility that a quarter-point drop in the policy rate will fail to have the desired effect on Spanish GDP 3 quarters out. It is rather that markets have decided it is time to price in the possibility that Spain will exit the euro, a scenario no one is completely prepared for. I am sure that Mario Draghi, and I suspect even Jens Weidmann, do indeed see things this way. But as I said at the beginning, framing the argument in terms of the transmission channel is convoluted. Thinking instead about par, about the price of European money in terms of European money, leads, I think, to a clearer argument. In any case, the plan for outright monetary transactions will at best buy time. Spain may be able to borrow more cheaply to support its banking system, whose assets will also be worth more when the ECB is buying. But how much more? The ECB offered unlimited quantity, maybe, but with no target price. The final determination of that quantity rests on a political process. Jens Weidmann has made no secret what he thinks about bond purchases. So I began from par and then turned to look at the internal challenges faced by the Eurozone. Let me now turn outward to see the challenges posed by the crisis for the Eurozone's near neighbors. First, Denmark. Bound by ERM2 to hold its exchange rate, the exchange rate between the euro and the krona, within a narrow band, the Danish central bank faces a problem not entirely different from that faced within the Eurozone. Holding an exchange rate peg is similar to holding par, but the national money retains its name, and the adjustment is unilateral on the part of Denmark rather than multilateral with a fixed integrated institutional structure. Without an integrated payment system to absorb net flows, the central bank must allow its own balance sheet to absorb them or use monetary policy to reduce them. Let me explain. The Danish central bank has essentially two mechanisms for adjustment as it seeks to hold the krona-euro rate fixed, exchange rate fixed. It can adjust its policy interest rate to make holding kroner more or less attractive, or it can allow expansion of its own balance sheet, printing new kroner to buy net euro inflows at its desired rate. So first, let me take the second one first. This is sort of a schematic. Danmarks Nationalbank is the Danish central bank. And in response to the rest of the world wishing to exit some position denominated in euros, say a holding of euro sovereign bonds, and enter a position in Danish kroner as a realistic fixed exchange rate alternative with, in many respects, similar characteristics, at least from the point of view of a speculator or another investor holding a position in euro, although clearly a much smaller market and probably not very able to absorb the resulting flows. As the rest of the world wishes to modify its portfolio like this by exiting euro and entering Danish kroner, the Danish central bank can adjust interest rates to make that adjustment in portfolio more or less attractive. But once it's done that, anything that's left, it needs to respond like this by purchasing up any net inflow of euros and paying for them with newly issued kroner. If it didn't do this, if it failed to meet the demand for kroner against incoming euros, if it failed to do that, the imbalance would fall onto the private foreign exchange market, which would adjust the exchange rate to balance, to absorb the net flow, and the current pressure for kroner appreciation would quickly move the exchange rate outside of the ERM2 band that Denmark is committed to. And so that's balance sheets, and here's the exchange rate. So this is from Danske Bank research via the Financial Times blog FT Alphaville. You can see that normally Denmark sets its borrowing and lending rates in a channel around the ECB refi rate. So that's here. That's here. This is through, let's say, third quarter or so of 2011. The red rate here and the blue rate here are the policy rates of the Danish central bank. And normally it found that it worked pretty well to set them in a channel that encompassed or surrounded the ECB refi rate. As the euro crisis heated up, inflows into Danish kroner increased, and they found that the Danish central bank needed to make the proposition of holding kroner less and less attractive, which it did by lowering the interest rate quite significantly outside of the sort of previous normal back here. And since this graph stops in mid-2012, and since this time, this blue line has actually gone below zero to negative 0.2 or so. So even at those negative policy rates, Denmark still finds itself absorbing unwanted euro-denominated assets. So how does this relate to the theoretical view at the beginning? Well, ERM2 is a weaker version of par. Denmark is committed to holding fixed the price of its money against the euro, but without the silent and automatic operation of the payment system. So it has to take a DIY approach, using its own balance sheet to absorb net flows. I'm happy to let this example stand on its own, but if you'd like a deeper connection to the theory, I would say that Denmark's challenge makes explicit and visible what is implicit and obscured in the Eurozone. Will Denmark let its peg fall? That decision will be made in Copenhagen. Will the Eurozone break apart? Well, whose decision would that be? It's not quite clear. How am I doing for time? Excellent. In 2 minutes, just to keep time, I have something to say about Switzerland, and I'm not going to say it now, so come and find me over coffee, and I'll say it. Well, or you can ask questions about Switzerland. As a theorist, I prefer to offer, so I'm closing here. As a theorist, I prefer to offer understanding and synthesis rather than opinions and predictions, but since I insist on studying the real world, let me at least take a stab. Draghi's outright monetary transactions is not, by itself, enough to save the Eurozone. The problem is that the payment system is overburdened. Its job is to guarantee par against the rising and falling tides of intra-Eurozone payments, yet it is being asked instead to bear the accumulated billions of net flows out of the periphery and into the core, especially into Germany. These flows must be reversed, at least over time. There are a number of ways out, none of them particularly palatable. The periphery can sell assets to Germany. They can change their exchange rate, or we can wait for macroeconomic change. The first is politically quite difficult. The second is nearly impossible within a monetary union. And the third takes a long time. Outright monetary transactions may ease the strain on peripheral banking systems, as 3-year, longer-term refinancing operations did a few months ago, around the beginning of 2012. But without a price target, it is hard to see how sovereign debtors have gained any room to maneuver. Without room, it is hard for them to help their banking systems, perpetuating the cycle. At the same time, the Eurozone's European neighbors are hanging on for dear life. Do not let our exchange rate with the euro be the point of macroeconomic adjustment in response to troubles in the Eurozone, they say, in effect, and they're quite right to say it. So they have tied themselves as tightly as possible to the euro without actually adopting the single currency. They are isolated from one shock, but like the payment system inside the Eurozone, the central banks of Denmark and Switzerland are being asked to carry assets that they are uncomfortable with. Their balance sheets will not be able to expand forever. Political reality will eventually force them to allow appreciation, threatening domestic exporters and risking deflation. The question is whether strains in the Eurozone will lift before the Danish Central Bank and the Swiss National Bank reach their limit. Thank you for your attention. I have time for a few questions now and more questions afterwards.
Great. Thank you, Daniel Neilson. Any questions or comments? Okay, we have 2 here. Maybe we start over there.
Dan, maybe you can answer this. I've been wondering for some time how the European Central Bank actually adjusts its accounts when it buys sovereign debt from Spain, say. I'm going to formulate it in a naive way. Where does it get that from? Obviously, it creates it. But how does the accounting actually work? And as a follow-up question to that, if they're capable of essentially declaring into existence some reserves in order to soak up that sovereign bond debt that's issued by Spain, what would stop them, technically, from saying something like the following? We will credit all of the countries in the Eurozone with, I don't know, let's say an equal per capita bonus. We will create non-debt money, and we will credit this money in such an amount that essentially it will wipe out Spain's debt, and it will give Germany a whole bunch of money, or Germany's central bank a whole bunch of money, which is non-debt money. So in other words, you're not simply being unfair by wiping out somebody's debt. You're saying, well, in proportion, in compensation for the fact that we're giving Spain a freebie in this sense, we're giving Germany a freebie too. So we're wiping out Spain's debt, and we're making Germany richer, and so the proportional wealth of the two countries remains roughly equal. So that would be a way maybe of getting rid of this debt without actually being unfair or punishing the creditors.
Okay, let me try. So I think, so the first question first. When the Eurozone or the Euro system or any central bank buys an asset, typically it would buy it on the secondary market, meaning it buys it from a dealer, often in the same building as a bank of the same name. It bids for bonds, takes the best price that it gets in response to that. It accepts bids for bonds, takes the best price that it gets, and pays for it by writing a check, essentially, by increasing the reserve accounts of the bank at which the dealer does its banking. So in effect, it does something like on a double entry basis, it comes from the purchase of the assets themselves. Because so the key thing here is that let's see, where do I want to be? Well, they have an asset against it. They used it to buy an asset. So I mean, it's when a central bank buys. I don't really have a good balance sheet to use there. When a central bank buys something. Money is different for a central bank because money is a liability of the central bank. So, unlike everyone else, a central bank can print the greatest, the best money by simply making an entry in its own books. But it's actually no different than what a private bank does when it extends a new loan, which is just like buying a bond in some sense. It extends a new loan and increases its deposit liabilities against that loan, and the effect is an expanded balance sheet of a private bank. It's really essentially the same transaction, except that a private bank is bound by a reserve requirement, and so somewhere it has to go and find some quality asset to stand against its newly enlarged deposit liabilities. Quickly, as to your second question, I think that a proposal of that kind fails to take account of the complexity of people holding the bonds on the other side. There's a huge, you could call it an ecosystem built up around the existence of sovereign debt. And although, if you view it narrowly, sure, it would be a good thing to wipe out Spanish sovereign debt, but not if it took down substantial parts of the financial system while you did it.
We'll continue maybe that discussion afterwards.
Okay.
After
I'm
the
happy
session.
I'm happy to take it up with you after, but I guess we
Right.
should give some time for
And
a
then
couple
we'll have
other
one more
questions.
question here.
Okay. I think you said that when the OMT is conducted by the ECB, somehow the Spanish government will get money. I think you were a bit clearer now in this answer to the question, because of course that's not the case.
Right.
Because the ECB is buying them.
It's not directly the case.
Yeah,
That's right.
because the ECB is buying on the secondary market, not the primary market.
Yes, yes.
And so ultimately what's likely to happen is that banks swap bond holdings for reserve holdings, which really doesn't change anything and doesn't do the economy any good. So it may have the effect that they desire to push down yields, but it doesn't lead to any sort of net balance sheet expansion if you take the banking system and the central bank together. So the real question I would like to ask is, the ECB simultaneously announced that it will sterilize all this. So what do you say?
Okay, let me respond to both parts. So the first is that you're absolutely right in a technical sense that I certainly simplified here where I wrote this way. However, I think that probably in effect, to some extent this is true for two reasons. One, if banks know that the ECB is buying Spanish debt, then they'll be happy to buy newly issued Spanish debt, knowing that they'll be able to quickly sell it on to the ECB. And so in turn, Spain, recognizing that, will be happy to issue more debt because they know that they'll be buyers. I think that if people didn't expect this to happen, then this whole plan wouldn't make any sense in the first place.
Sorry, but this doesn't work because the OMT is only conducted if they agree to submit to the various fiscal and budgetary EU rules and requirements, and I don't think they include that they can keep expanding and issuing more debt.
Could be, fair enough. As for sterilization, sterilization is mostly about the concern that that expanding central bank reserves will lead ultimately to inflation. Since the pressure would seem to be, at least in many parts of the Eurozone, currently more toward the side of deflation than inflation, I'm not sure that sterilization is really at the core of the issue. Although I know it's a concern at least to some.
For further questions or comments, I would just ask you to address Daniel Neilson after the session outside in the cafe. And thanks again for being with us, Daniel Neilson from INET.
Thank you for having me. Thanks.
Und wir machen hier weiter in 2 Minuten nach einem kurzen Umbau mit monetären Reformoptionen. Und wir würden uns freuen, wenn viele Leute hier bleiben und kontrovers diskutieren. Dankeschön.